If you trade S&P E-mini futures contracts like I do, you probably know that there are 4 contracts throughout the year, designated by letters H, M, U, and Z. And those contracts last for 3 months. They last for a quarter. H, M, U, and Z standing for March, June, September, and December. Now, you might be curious as to why there are contracts and why they expire. Well, the concept of contracts, the concept of futures contracts, dates back to the time where agricultural products were traded. And agricultural products, of course, at a point in the year, they're harvested, then they have to be sold to the wholesalers, and then further on down the line. And so there were specific times of the year where these commodities had to be sold because of the nature of trading in grains and other agricultural commodities. So the concept of contracts and contracts that expire probably dates back to that time. But nevertheless, there are 4 futures contracts throughout the year, designated with the letters H, M, U, and Z. And we're switching from the September, the U contract, to the December, the Z contract. Now you're looking at my chart of the E-mini, S&P E-mini, and you'll notice that on my watch list I have ESZ, ESU, and ES1. Now, first of all, the ESZ is the contract that we're just rolling into, the Z contract, the December contract. And that's what you're seeing on my screen. Up until last week, up through last week, I was trading the U contract. And so I want to call your attention to the fact of the absolute values of the contract prices. The Z contract, the contract that you're seeing on my screen, the prices that you're seeing, right now is trading at 45.27. And you'll notice the U contract, the contract that's expiring, is trading at 44.78. So about a 50-point difference. So there's an absolute difference in the numbers that they're trading at. But I want you to notice that the actual change in the prices between the 2 contracts is exactly the same. Nevertheless, during the times of the rollover, we want to roll over our contract to the new contract, in this case, the Z contract. Now, there's one more thing that I want to point out in terms of the difference in price between the expiring contract and the new contract. As you'll note, there's the ESU trading at 44.78, the ESZ trading at 45.27. But there's also an ES1 contract. The ES1 contract is called a continuous contract. It doesn't change, and you can trade the ES1 throughout the year without trading the actual contract month. So you'll notice that the ES1 is exactly the same price as the ESZ. The ES1 contract, or the continuous contract, always trades at the same price as the contract going forward, which is today the Z contract. Last week, the ES1 was trading at the same price as the U contract. So in other words, you can trade the ES1 throughout the year and not switch, or you can trade the ESZ or U or M or H and switch over depending upon what month you're trading. Now, since the numbers in the contracts change, I have to change the numbers when calculating using the Taylor trading technique or the Taylor trading calculator. And so I have to modify my Taylor trading calculator to accommodate the change in the absolute numbers. In this case, it's 50 points between the U and the Z contract. Nevertheless, I have to do this in order to recalculate my Taylor trading zones. So in order to do that, what I do is I go to my Taylor calculator, and here's my calculator using numbers from the previous month, the previous contract month. And what I can do is I can just take the last several dates. In this case, I'm going to take 4 rows of dates from September 6th through the 11th, and I'm going to remove those numbers. I'm going to delete those numbers. And for the U contract, I'm going to replace them with the same date numbers for the Z contract. And what I'm going to do in that, I'm going to replace these date numbers, open, high, low, close, and it automatically recalculates based on the new numbers, the new open, high, low, close. So that's how I switch when I'm using the actual contract months. Of course, as I said, if you're using the Taylor calculations, you can use the continuous contract, the ES1 contract, but this is a convenient way. There are two ways to do it. You can use the ES1 continuously, or you can just delete the last several rows of the expiring contract, replace them with the open, high, low, close with the new contract. So that is a brief explanation of contract rollover and expiration, and that's it. So today, September 12th, have a great day. Thanks so much for watching. Trade safely, and I'll see you in my next video. Marv Eisen for Timeless Dollar Trading Academy.